SpaceX's stock is falling. This is how fortunes are lost by misreading one simple signal. Here's what's really happening. This isn't a sign of failure. It's the exact same pattern that played out after Facebook's disastrous IPO, which then created a generation of millionaires. But the real reason has nothing to do with rockets and everything to do with a hidden market event that separates insiders from the public. And it's happening right now. In late 2023, headlines quietly reported that SpaceX's private shares were trading hands at a valuation below its last funding round, a dip below a key psychological level. To the outside world, this looks like a crack in the armor of one of the world's most valuable private companies. If SpaceX is launching more rockets than anyone in history and Starlink is connecting the globe, why would its value be falling? The answer isn't in its operations. It's in the structure of the market itself. And to understand it, we have to look back at one of the biggest failures in Silicon Valley history. May 18, 2012, Facebook goes public. It was the most hyped IPO in years. It opened at $38 a share and immediately began to sink. Within months, it had lost over 50% of its value, trading below $18. The media called it a disaster, a flop, proof that social media was a fad. Retail investors who bought into the hype were wiped out. But the professionals weren't watching the stock price. They were watching the calendar. Here's the part they don't teach you: the IPO lockup expiration. By law, for 90 to 180 days after an IPO, company insiders and early investors are locked up. They are forbidden from selling their shares. This prevents an instant crash on day one. But when that lockup period expires, the floodgates open. Millions of shares, bought for pennies years earlier, are suddenly eligible to be sold. It's a massive, predictable increase in supply. And basic economics tells you, when supply skyrockets, price plummets. This is exactly what happened to Facebook. The post-IPO crash wasn't a verdict on its business. It was a mechanical, temporary market event. Once that wave of insider selling was absorbed by the market, the stock found its bottom. And from that disaster low of under $18, Meta began a climb to over $500, becoming one of the best-performing assets of the decade. So what does Facebook's history have to do with SpaceX today? Everything. SpaceX isn't public yet, but it operates a similar system in the private secondary markets. The company periodically allows employees and early investors to sell a portion of their shares in controlled events called tender offers. When a new batch of shares becomes available from these early stakeholders, you see the same effect as a lockup expiration, a temporary glut of supply that pushes the private market price down. Panicked observers see a falling price and think the company is in trouble. But insiders see it for what it is: employees who have been with the company for a decade finally cashing in on a small piece of their life's work to buy a house or pay for college. It's not a vote of no confidence, it's a planned liquidity event. The lesson here is critical. Short-term price movements, especially around predictable liquidity events, are noise. They are not a signal of a company's fundamental health. The real signals for SpaceX are its launch cadence, Starlink subscriber growth, and Starship's progress. Those metrics tell the story of value creation. The price is just a temporary story of supply and demand. So, when SpaceX finally does IPO, will the inevitable price dip be a trap for the public or a once-in-a-generation buying opportunity for those who understand the game? Today, we decode how predictable supply and demand shocks, like the one seen with Meta's IPO, are often misinterpreted as company failure. Smart money sees these events not as a crisis, but as a calendar entry. If you want to keep decoding the hidden rules of finance, subscribe to our channel. In our next video, we reveal the single number on a company's balance sheet that can predict a layoff 6 months in advance. Now you see how the money really moves. Money Decoded.